Welcome back to BitcoinDorks. Today, we're delving into a concerning trend identified by Glassnode, a leading on-chain data provider. It seems that Bitcoin newbies are panic selling at a loss following a recent price crunch. So, what's behind this behavior, and what does it mean for the broader cryptocurrency market? Let's dive in. According to Glassnode, a significant number of newcomers to the Bitcoin market are succumbing to panic selling in the face of recent price volatility. This panic selling behavior is characterized by individuals offloading their Bitcoin holdings at a loss, often driven by fear and uncertainty surrounding the market's direction. The pervasive influence of social media platforms and mainstream news outlets exacerbates the problem, as sensationalized headlines and fear-inducing narratives can deeply penetrate the psyche of inexperienced investors. In today's hyper-connected world, information spreads rapidly across various digital channels, amplifying both positive and negative sentiments within the cryptocurrency community. The allure of sensational news often leads to the proliferation of fear-inducing narratives that prey on investors' emotions. The incessant deluge of sensationalized headlines, coupled with fear-inducing narratives, has the potential to instill a pervasive sense of FOMO, fear of missing out, or FUD, fear, uncertainty, and doubt, among inexperienced investors, further exacerbating their emotional state and impairing their judgment. The constant barrage of alarming news can create a climate of anxiety and uncertainty, wherein investors feel compelled to take immediate action in response to perceived threats to their investments. This heightened emotional state often leads to impulsive decision-making, as individuals seek to mitigate their perceived losses or avoid the possibility of further downside risk. However, this knee-jerk reaction to market volatility can have detrimental consequences in the long run, as panic selling may result in realizing losses and missing out on potential recovery opportunities. Thus, the cycle of heightened emotional states and impulsive decision-making perpetuates a self-reinforcing pattern of behavior, wherein investors become trapped in a cycle of anxiety and reactive responses to market fluctuations. Breaking free from this cycle requires a concerted effort to cultivate emotional resilience and discipline, enabling investors to make rational decisions based on a sound understanding of market dynamics and their own investment goals. By developing a comprehensive investment strategy and sticking to it, investors can mitigate the impact of emotional biases and avoid falling prey to panic-induced selling during periods of market volatility. Fostering a supportive community and seeking guidance from experienced investors can provide valuable perspectives and help inexperienced investors navigate turbulent market conditions. Engaging in constructive discussions and sharing insights with peers can help dispel irrational fears and reinforce confidence in one's investment decisions. Adopting a long-term perspective and focusing on the intrinsic value of assets can be a cornerstone of a resilient investment strategy, particularly in the volatile world of cryptocurrency. When investors anchor their decisions on a deep understanding of the fundamental value drivers of the assets they hold, they are better equipped to weather short-term fluctuations and resist the temptation of panic-induced selling. In the cryptocurrency market, where prices can experience dramatic swings in relatively short periods, maintaining a disciplined approach to investing is paramount, rather than reacting impulsively to every market fluctuation. Investors who adhere to a long-term investment horizon are more likely to stay the course and avoid making decisions based on short-term emotions. By aligning their investment decisions with their long-term objectives, investors can develop a sense of clarity and purpose that transcends the noise of short-term market movements. This clarity enables them to filter out distractions and focus on the underlying value propositions of the assets they hold, regardless of temporary price fluctuations. A disciplined approach to investing involves setting clear investment goals and adhering to a predetermined investment strategy. Whether it's dollar-cost averaging into positions over time, rebalancing portfolios periodically, or setting stop-loss orders to mitigate downside risk. Having a well-defined investment plan can provide investors with a sense of structure and confidence in the face of uncertainty. Maintaining a diversified portfolio is not only a prudent risk management strategy but also a key factor in achieving long-term investment success. Diversification involves allocating capital across a variety of asset classes, sectors, and geographic regions to spread risk and reduce the impact of volatility on overall investment performance. In the context of the cryptocurrency market, where volatility is inherent, diversification can play a critical role in mitigating risk and protecting investors from the unpredictable nature of individual assets. By spreading their investments across multiple cryptocurrencies, as well as traditional asset classes such as stocks, bonds, and commodities, investors can reduce their exposure to idiosyncratic risks and minimize the impact of adverse price movements on their portfolios. Diversification allows investors to capture opportunities in different market segments and capitalize on the strengths of various asset classes. For example, while cryptocurrencies may offer the potential for high returns, they also come with higher volatility and regulatory uncertainties. By complementing their cryptocurrency holdings with traditional assets, investors can achieve a more balanced risk-return profile and enhance the stability of their portfolios. Geographic diversification can further enhance portfolio resilience by reducing exposure to country-specific risks and geopolitical events. By investing in assets from different regions around the world, investors can minimize the impact of localized economic downturns or political upheavals on their overall investment performance. Sectoral diversification enables investors to hedge against the risks associated with specific industries or sectors that may be prone to cyclical downturns or regulatory challenges. By spreading their investments across sectors such as technology, healthcare, finance, and consumer goods, investors can reduce concentration risk and ensure that their portfolios remain resilient to sector-specific shocks. In conclusion, navigating the volatile world of cryptocurrency requires a combination of emotional resilience, disciplined decision-making, and strategic portfolio management. By understanding the underlying fundamentals of the assets they invest in, adopting a long-term perspective, and maintaining a diversified portfolio, investors can position themselves for success and weather the inevitable ups and downs of the market. That's all for today's video. See you in the next video.